Hey and welcome back. This is Joshua Talks Money. I'm Joshua, and today we're going to be talking about Vanguard's VOO, which is their S&P 500 ETF. I'll walk through kind of what it is, explain the basics, and then really dive into why you should actually care. And so we'll do that here in a few minutes. Let's get started. All right, so the S&P 500 is basically an index that tracks the largest and strongest 500 companies in the US stock market. Now, these are the companies you would probably imagine, like Apple and Amazon, and 500 total that are all kind of put into this index and monitored from a day-to-day basis. So the S&P 500 has been a thing since 1957, basically, and VOO was actually launched in 2010. So we just crossed that 11-year mark here in September. And so VOO is basically Vanguard's ETF that allows you to purchase the S&P 500 index and get the benefit from the growth of those 500 companies. And they do this by offering shares. The shares, I think, are around $400 as I'm filming this video. And in that $400 is a little slice of all those 500 companies. So it's a really great way to get exposure to the top 500 companies in the market without going and buying each one. And if you think about that, Amazon trades for around $3,200 per share as I'm filming this. And so instead of going and buying, tens of thousands of dollars worth of stock in each individual company, you can get it all in one share price. And that's what this ETF does. Something else to know is this is weighted by the market cap of each company. So I like to think of the bigger the company, the bigger slice of the pie that they make up. And so something like Amazon takes up a huge slice of the pie. In fact, the top 10 holdings make up about 30% of that fund. Okay, so why do you even care about VOO? Well, you maybe got to this video because you're trying to decide where you put your money when you're trying to track the S&P 500 index. Are you going to do that in an ETF like VOO? Are you going to do that in another ETF like SPY or maybe a mutual fund? And there's a lot of options because there's a lot of funds that track this same index. And so what I try to think about is something called the expense ratio. And maybe you've heard me talk about this before. This is basically the cost that's required to own shares in that fund. The great part about VOO is it has an extremely low expense ratio of 0.03%, 3 basis points. I've talked about that on my video on VTI. That's the total stock market. But it's a very low cost to owning VOO. And what that translates to is for every $1,000 you have invested, you're going to pay fees of, get ready, 30 cents, which is extremely low. Some other funds will charge, upwards of 1%. And what that means is for every $1,000 you have invested, you're paying $10 in fees. And that can really significantly eat away at your investments over time, especially if you have a very significant account balance. So I like to think of what's going to get me the same returns that the S&P 500 would give, but at the lowest cost to myself. And another big question that I'll do another video on separately is, well, what about a mutual fund versus an ETF, both that track the same index? Well, Vanguard does have ticker symbol VFIAX, the Vanguard S&P 500 index, these Admiral shares, and basically that's going to get you the same thing as the ETF in terms of the companies you hold and in terms of the performance. The main difference is it's a mutual fund instead of an ETF. One thing that you'll probably care about is to get access to that mutual fund, you need to pay a $3,000 minimum, where to own an ETF, you only have to purchase one share. So for VOO, you can own it right now for about $400. Something like the mutual fund, you're going to need about $3,000. As I've said before, I prefer the ETFs because I can get in and out. I like that they trade like a stock. I can see the fluctuations. I know as a long-term investor, we're not supposed to watch the market fluctuations. I do every day. And I think it's fascinating, and I like to see that, and VOO lets me do that. And so on average, the S&P 500 has returned around 10%. Now there's going to be years where it's far greater. There's going to be years where there could be a pullback or a recession. But on average, I think that's the rule of thumb a lot of people use is, hey, if I put in this money, I am looking for around a 10% return on my investment. And one last thing, if you think about, iconic, brilliant investors of our time, of course, Warren Buffett comes to mind. And something that's really fascinating that Warren Buffett has said is when he passes away, 90% of his wealth will be put into an S&P 500 index fund. And I think that speaks to the power and the ease of this type of investing. His entire multi-billion dollar personal fortune was created from kind of picking stocks and picking his positions over time, often winners and losers. But he's done really well with that strategy. That strategy does not work for most people. If it did, we'd all be like Warren Buffett. And so I think that he recommends for the average person to go ahead and invest in the index. And he's going to do that when he passes on for his own family. All right, and that's about it. A quick intro into VOO. We'll do some more videos on this topic, diving in a little bit deeper into the numbers. Hey, and if this was helpful for you, please consider subscribing. I'd love for you to join me as I continue to learn about personal finance and on my road to financial freedom. We'll be back next week. We'll talk to you soon. Bye.